Good morning. Welcome to the War Room. I am Malik. Today is Monday, March 16th. Notice that we did not drop a tape on Friday morning. We deployed our battle plan straight to the timeline and went completely radio silent on the audio feed. Why? Because when the market is preparing for a controlled mechanical operation, the worst thing an analyst can do is add to the noise. We needed you to sit in absolute silence and watch the institutions execute exactly what we outlined. We warned you about the Friday phobia. We told you the smart money would refuse to hold heavyweights over a war-torn weekend. And without the noise of a morning broadcast, you watched them perfectly execute a controlled risk-off operation. There was no chaotic 11,000-point liquidation. There was no phantom short squeeze. Instead, the market underwent a systematic bleed. The KSE-100 index drifted downward, shedding roughly 550 points to close the week right around 15,390. Today, we are zooming all the way out. We are running a deep dive institutional-grade analysis on this 15,390 support zone. We are going to map out exactly how the capital is preparing to rotate this week, and how the massive 55 rupee fuel shock is currently mutating the corporate order book. Let us start with a forensic breakdown of Friday's volume profile. When you see a 550-point drop, you might think it is just a mild red day. But as a tape reader, you have to look at how those points were lost. The drop to 15,390 was not caused by aggressive sellers hammering the bid. It was caused by an absolute lack of buyers. The institutions simply pulled their bids. They stepped entirely away from the order book. When there are no institutional buyers willing to step in, even a tiny amount of retail panic selling will cause the price to drift lower. We call this a liquidity vacuum. This tells us something critical about the psychology of the smart money right now. They are not in a blind panic anymore. The weak, heavily leveraged retail accounts were completely washed out during last week's bloodbath. The capital remaining in the market right now is institutional, calculating, and waiting. They are holding the line at 15,390, refusing to deploy fresh capital until they see exactly how the corporate boardrooms are handling the macro rot. To understand what the institutions are waiting for, you must understand what they are currently digesting. The 55 rupee petrol and diesel shockwave is no longer just a headline. It is actively ripping through Q2 corporate balance sheets as we speak. We are tracking a massive divergence in the market. The institutions are separating companies into two categories: the price makers and the price takers. A price maker is a company that can pass the 55 rupee fuel hike directly onto the consumer without losing sales volume. A price taker is a company that has to absorb that cost because the consumer is already tapped out. The cement and textile sectors are currently operating as price takers. With the Afghan transit trade locked down by the Western border conflict, they have massive excess inventory. They cannot raise their prices, so their profit margins are being entirely cannibalized by the freight and energy costs. The smart money knows this, which is why they are mathematically repositioning their portfolios away from manufacturing and into defensive bunkers. That brings us to today's corporate calendar, Monday, March 16th. The PSX boardroom meeting today is a masterclass in macroeconomic survival. We have three major catalysts, and they perfectly represent the exact sector rotation I just described. Mark your screens for these times. 10:30 a.m. K Electric Limited. The energy giant is holding a meeting in Karachi to consider matters other than financials. K Electric is the absolute beating heart of the industrial hub. When they call a mystery meeting during a massive energy shock, they are likely restructuring debt facilities or emergency generation matrices. Do not take your eyes off the energy board at 10:30 a.m. It will dictate the morning momentum. 11:30 a.m. Pak Elektron Limited. They are dropping annual accounts in Lahore. Pak Elektron is a massive proxy for consumer purchasing power and manufacturing margins. We need to dissect their forward guidance to see exactly how much of the energy inflation they are absorbing versus passing on. 11:45 a.m. Abbott Laboratories Pakistan Limited. This is the defensive bunker. Abbott is a premier blue-chip pharmaceutical heavyweight. When the macro environment collapses, institutions execute a flight to safety. They pull their cash out of highly leveraged tech and crippled manufacturing, and they park it in pharmaceuticals because healthcare demand is inelastic. People will stop buying appliances, but they will not stop buying medicine. If Abbott drops strong numbers, watch the institutional volume violently rotate into the pharma sector today. Here is your battle plan for Monday,
1. Respect the consolidation zone. The index is hovering around 15,390. We are in a sideways holding pattern. Do not expect explosive market-wide breakouts today. The capital is moving laterally between sectors, not pouring into the broader index. 2. Trade the divergence. Watch the weakness in textiles and cement, and contrast it with the volume flowing into defensive sectors like pharma and fertilizer. The game right now is sector rotation. If you are positioned in highly leveraged manufacturing, you are fighting the institutional tide. 3. Strategic patience. If you are sitting in cash, you have the ultimate luxury, time. You do not need to guess how K-Electric or Abbott Labs will guide the market. You can sit on your hands, wait for the data to drop at 11:45 a.m., and only deploy capital when the institutional footprint becomes obvious. We trade the mechanics, we respect the macro. Protect your capital, command the Monday. Disclaimer: StockSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented geopolitical volatility. Trade at your own risk.